Imagine someone with an IQ of 160, a brilliant doctor, a successful engineer, a tech, someone who can solve complex problems most people can't even understand. Now imagine that same person making terrible investing decisions. Buying stocks at the top, selling during crashes, falling for hype, losing money repeatedly. Sounds impossible, right? But here's the strange truth. Some of the smartest people in the world are also some of the worst investors. In fact, being highly intelligent can sometimes make you more likely to lose money in the market. And today, we're going to break down exactly why that happens. Intelligence versus investing. Most people assume investing is mainly about intelligence. If you're smarter, you should be better at it. But investing isn't actually an IQ game. It's a behavior game. One of the greatest investors of all time, Warren Buffett, once said, "Investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. In other words, once you're reasonably smart, more intelligence doesn't help much. What matters far more is emotional control, patience, and discipline." And ironically, these are exactly the things highly intelligent people sometimes struggle with when it comes to money. Overconfidence. The first reason smart people make bad investing decisions is overconfidence. When you're used to being right most of the time, you start believing you can outsmart the market. You think, "I've analyzed the data. I understand the company. I see something others don't." But the market is not a normal problem. You're not competing against average people. You're competing against millions of investors, including hedge funds, algorithms, and professionals whose entire job is to find tiny advantages. Even Isaac Newton, one of the greatest scientific minds in history, fell into this trap. During the South Sea Bubble in 1720, Newton invested early and made a profit. But then he watched others getting richer. So he jumped back in at the peak. When the bubble collapsed, he lost a fortune. Afterward, Newton famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." Even geniuses underestimate market psychology. The complexity trap. The second problem is something called the complexity bias. Smart people often believe complex solutions must be better. So they start creating complicated investment strategies, advanced technical indicators, exotic option strategies, complicated portfolio models. But in investing, simplicity often wins. The data consistently shows that simple strategies like buying diversified index funds often outperform active traders over time. For example, the S&P 500 has historically beaten the majority of professional fund managers. The market often rewards consistency, not cleverness. the need to be right. Another problem smart people face is something psychologists call ego attachment. When intelligent people form an opinion, they often become emotionally invested in being correct. This becomes dangerous in investing. Because successful investors need to constantly admit, "I was wrong." But that's hard for someone who has spent their life being rewarded for being right. Instead, they hold losing stocks too long, double down on bad investments, ignore evidence that contradicts their beliefs. Great investors do the opposite. They cut losses quickly and move on. As legendary investor George Soros once said, "It's not whether you're right or wrong that matters, but how much money you make when you're right and how much you lose when you're wrong." The illusion of control. Smart people also love control. They believe if they analyze enough data, they can predict outcomes. But markets are influenced by things no one can fully predict. Global events, interest rates, human emotions. Even top investors get things wrong all the time. What separates successful investors is not prediction. It's risk management. Instead of trying to be right every time, they focus on diversification, long-term thinking, limiting losses. Investing success often comes from accepting uncertainty, not trying to eliminate it. What actually makes a good investor? So if intelligence isn't the key, what is? The traits that actually make great investors are surprisingly simple. Patience, discipline, emotional control, long-term thinking. This is why some of the best investors follow very boring rules. Invest regularly. Diversify widely. Ignore short-term noise. Hold for decades. It's not exciting, but it works. So here's the big takeaway. The market doesn't reward the smartest person in the room. It rewards the person who can control their behavior the best. And sometimes the most powerful investment strategy is also the simplest. Stay patient. Stay disciplined. And let time do the heavy lifting. If you found this video helpful, subscribe for more content on psychology, money, and smarter decision-making.